Hey everyone, and welcome. Today we are jumping into a world where the bottom line isn't about profit, but about purpose. We're going to demystify the unique and honestly fascinating financial world of not-for-profit organizations. Let's get right into it.
So, it really all comes down to this one question. If you run a regular business, it's easy. You look at your profit. Simple. But what about a charity or a local sports club? How do they know if they're knocking it out of the park? What does a good year even look like for them? That's the core puzzle we're going to solve together today.
So first up, let's tackle this NPO puzzle head-on. To understand their finances, you first have to understand what makes them tick.
And this right here is the absolute heart of the matter. An NPO exists to serve a mission. It's all for the benefit of society. There are no shareholders waiting around for a payout. The entire goal is service, not making someone rich. And that one single difference changes absolutely everything about how they have to handle their money.
This little side-by-side makes it all crystal clear, doesn't it? Businesses are about profit. NPOs are about service. So when a regular company has money left over, we call it net profit. But for an NPO, it's a surplus. And if they're in the red, it's a deficit. Now, this isn't just about changing the words. It's a totally different mindset that reflects that core mission we just talked about.
Okay, on to our second section, the cash story. This is where we meet the first of their key financial reports, the receipts and payments account.
Honestly, the best way to think about this account is to just picture your own bank statement at the end of the year. That's it. It shows every single dollar that came in, the receipts, and every dollar that went out, the payments. It's just a pure, simple summary of cash movement. Money in, money out.
But here's where it gets a little messy, and this is so important to understand. It's a complete list of cash transactions, which is great, but look what gets all lumped together. A donation for next year's big event is sitting right next to a payment from last year's fundraiser. And buying a whole new building, a huge long-term thing, is on the same list as buying printer paper. You see the problem, right? It tells you how much cash you have in the bank, but it tells you absolutely nothing about how you actually performed this year.
And that leads to this exact problem. Let's say a giant check for a building project that starts next year lands in your account on December 30th. Well, the receipts and payments account would make it look like you had an unbelievably successful year. But did you really? No, you didn't earn that money for this year's work. And that is precisely why NPOs need a much smarter tool.
And that smarter tool brings us to Section 3, actually measuring the success of the mission with something called the Income and Expenditure account.
Okay, this is the NPO's real performance meter. If you're familiar with the business world, this is their version of the profit and loss, or P&L statement. Its entire job is to laser focus on the current year and answer one simple question. Did the income we generated this year cover the expenses we had this year? This chart really is the key to the whole thing. The receipts and payments account works on a cash basis. It only cares when money physically moves. But the income and expenditure account, that's on an accrual basis, which means it cares when income is earned and when expenses happen, no matter when the cash actually changes hands. It's a huge difference. That's why the I&E account filters out all the noise. It only looks at the current year and only at day-to-day revenue items to give you that crystal clear picture of performance, which results in that all-important surplus or deficit. So how does that filtering process actually work? Well, it's pretty logical when you break it down. Let's say you're a community club. You start with all the cash you got from member fees this year. Step 2, you take out any of that cash that was actually for last year's late fees or for next year's fees that someone paid early. Step 3, you add in any money that members still owe you for this year, even if you don't have it yet. And voila! The result is the actual true income that belongs only to this year.
All right, there's one more really interesting wrinkle we have to talk about. In the NPO world, sometimes money comes with very specific instructions.
This is where something called fund accounting comes in. The easiest way to remember it is donations with strings attached. It's perfect. If a donor gives a huge sum of money and says, this is only for the new scholarship fund, that money is firewalled. It cannot be used for anything else. Not salaries, not rent, nothing. It has to be tracked separately in a special scholarship fund. It's basically money with a mission of its own.
Okay, let's bring it all home with our final section. We're going to look at the big picture, the financial snapshot known as the balance sheet. The balance sheet does exactly what it sounds like. It provides balance. Think of it like a financial photograph taken on one specific day, like the last day of the year.
On one side of the photo, you have everything the organization owns, its assets, like cash, buildings, computers. And on the other side, you have everything it owes, its liabilities, like loans or unpaid bills.
And this all leads to the one core equation that holds everything together. Assets must equal liabilities plus something called the capital fund. So what's that? Well, the capital fund is basically the NPO's net worth. It's the grand total of all its past surpluses minus all its past deficits, all rolled into one number. It represents the value that truly belongs to the organization and its mission over its entire lifetime.
So there you have it. We've seen how all these different reports work together to paint a really clear picture of a nonprofit's financial health. But it kind of begs a bigger question, doesn't it? A healthy surplus is fantastic, but it doesn't tell you how many hungry families were fed or how much cleaner the local park is. It shows financial stability, but it doesn't measure real-world impact. And how you measure that? Well, that's a question numbers alone just can't answer.